The budget for the next financial year was welcomed by the equity market as the government made it clear that its priority was to continue pushing growth through a large increase in capital expenditure. The bond market, however, was less than happy as the centre announced a record high borrowing program. Yields on benchmark bonds have shot up to over 3-year highs. We have today the pleasure of hosting Mr. Arvind Chari, CIO of Quantum Advisors. Mr. Chari will share his views on the trajectory for both Indian equities and sovereign borrowing costs going ahead. Debt returns from mutual funds are set to go down as bond yields have shot up significantly in response to the borrowing numbers. What would your advice be for fixed income investors?
So we had put out a note last month in what we call our Debt Market Observer, and we had titled that that newsletter calling a great divergence. And we listed out 3 points on what is the divergence in terms of for fixed income investors. The first we laid down, and we can discuss that in detail, was the fact that when there is a pandemic and when there's a crisis, globally all central banks have a similar response. At a similar point of time, they will cut interest rates, they'll add liquidity, they'll buy government bonds, and they'll give moratorium and try and maintain the financial stability aspect. But if you look at the exits from the central bank, like many emerging markets have already hiked interest rates, they have already cut down liquidity. Many developed markets are now starting to do that. And when that happens, when there is a synchronous entry but a dysynchronous exit, that causes divergence, right? And you're seeing that happening in the bond markets globally, where global bond yields have shot up because expectations from the central banks, from different central banks, whether the UK or the US, which matters, or for emerging market central banks like China and India, expectations are varying. Communication is very, very different, and that causes volatility and everything. So that's one kind of a risk for fixed income investors. The second divergence was domestic in terms of the RBI till now has been very, very accommodative. They've done anything and more that the bond markets have asked of them over the last 2 years, 2020, 2021. And now there's a divergence, right? You know the RBI is going to hike. They will have to cut down liquidity. They might not be able to support the bond borrowing program as much. The third point of divergence was not everything is bad. When yields go up, of course, the medium tenor and the longer tenor of the bond markets suffers because when interest rates go up, when long-term bond yields increase, the long-term bond prices fall by more, right? But at the other end of the market, where if you look at segments like overnight funds or segments like liquid funds, ultra short duration, money market, these are lower maturity, so they invest in shorter tenor assets. That's thereby their mark-to-market risk is that much lesser. And as the RBI increases interest rates over the next year, the returns on those products will increase. It's such a divergence. There is a better outcome for short-term, low-risk mutual fund instruments, mutual fund products, or even fixed deposits. And there could be a bad, like a slightly more volatile, more riskier, and a lower return outcome for the longer run. So when you are in a scenario where the RBI and the central bank is going to tighten liquidity and increase interest rates, the best way to play that market is through something like a liquid fund, where every 90 days, kind of the portfolio matures. If a liquid fund is safe, invest in treasury bills, PSU bonds, and those kind of assets. As these rates go up, the returns on those liquid funds and those overnight funds, or even ultra short duration with slightly more mark to market risk, or money market funds with slightly even higher mark to market risk, will increase. So the best way to play a rate hiking cycle is liquid fund. On the longer end, on the medium tenor dynamic bond fund, long duration, those will be in trouble. That this will be a tough year for that segment.
Does the massive rise in bond yields pose the risk of equities losing attraction as an asset class, especially given the current valuations in the stock market?
So yes, stock market valuations are expensive, right? But there is a undercurrent of growth momentum that we are seeing. The government itself, when they commit for such high fiscal deficit, not only for FY 21-22, but up till 26, right? The amount of spending power that the government has, if they actually spend, implement it properly, efficiently, both center and state and PSU, it's a significant stimulus impetus that will happen over the next 2, 3, 4 years. That will itself, continue the growth momentum. And on a relative basis, if I look at India against, say, China, or India against other emerging markets, India has been a relative outperformer, especially over the last 1 year, 1-2 years. So from a foreign investor perspective, they will say, okay, I have better opportunities, better valuation in some other countries. And so that can be an impact of the valuation being high in India and opportunities being better. From an interest rate perspective also, if I look at a very long-term horizon, as I said, if I look at a 10, 20-year average, Indian bond yields have been between 7.5, repo rate has been between 6.5, inflation has been between 5.5, 6. And India has grown at 6.5, 7% real GDP, double-digit nominal GDP. So if I look at a zoomed out way, I don't see a major impact from interest rate. In the short term, because there is overvaluation, there is euphoria. And as interest rates go up, what you're asking is correct, where there could be some aspects of where investors will say, I'm better off if I am earning 7.5% in a fixed deposit. I'm happy to take that, and I think I should take some money out of equities. The risk could be that India faces one macro risk, which is oil prices. So right now also it is at a threatening level, but right now the impact is more on the bond market. The bonds are more worried about oil prices. But if it goes, say, 100, 110, then you will see that impact on equities, currency, all across, right? Because that's the short-term macro risk there. And in that case, you will see a valuation, your correction, and you will see bonds getting more attractive. So you'll have to weigh it like that.
Thank you very much for your time and for a very engaging conversation, Mr. Chari.